In today's video, I'll be giving you a recommendation of a stock that has a high potential of making you money. Now, this is the kind of stock that will make you rich. In our last video, I talked about a stock that was actually going to make you rich. Some of you thought I was actually joking, when I talked about Palantir. When I did that video, it was 1077, and today Palantir has actually grown over 20%. So those of you that took advantage of that stock, I want to say congratulations to yourself. Now, in today's video, I'll be giving you a recommendation of a new organization, and I want you to take action. However, before you take action, I will encourage you to please do your own due diligence. Do not just take my word for it. Whatever I say here is just for me to entertain you, at the same time educate you. You may incur losses, so please do your due diligence and do not just take my word for it, because I'm no financial advisor. My risk tolerance will be different from yours. Now, before I jump in and recommend this stock for yourself, I'll also encourage you to please subscribe to my channel, hit that notification bell, and smash the like button here. My recommendation for this week is DBX, which is Dropbox. That's the recommendation I have for you this week, Dropbox. And for those of you that don't know about Dropbox, Dropbox is actually a software organization. They're in the technology space sector in the US. Basically, what they do is that they provide cloud storage for people like yourself, or individuals and organizations, to actually store their files online. And they try to see how they can actually create a work environment online in the one space. So that's what they literally do. And as at yesterday, the market closed March 22nd, 2022. The market closed at $23.18. Now, the previous close was $22.93. And if you look at the open here, the market opened yesterday at $22.92. Now, this organization has a market cap of $8.847 billion, which means it has enough room to grow. There's room for it to grow. It can multiply these by 10 times and become a very big organization. And if you look at them, they have a PE ratio of 27.27 and EPS of 0.85. And then they have a price target for $33 at the end of the year, so which is a 1-year target here. That's an estimate given to yourself. Now, we'll just go to the website of this organization and really see what's going on here. So this is Dropbox Investors Relations here. And if you look at this, they have their bragging right put out there for yourself that in 2021, they raised 2.2 billion, not raised, they generated 2.2 billion in revenue. And in as at the end of 2021, they had over 700 million plus registered users. Now, I'm one of these registered users here. So registered users is different from paid users. So if you own Dropbox, you're a registered user. However, there are some people that pay for that service. So registered user is different. I will get into the financials to see how many people are actually paying and how much they're actually getting when it comes to their users. And they're currently present in 180 countries, which shows that it is big. They are moving, and this is why they have 700 million users. Full year fiscal 2021 result shows that their total revenue was $2.158 billion, an increase of 12.7% year over year. And on a constant currency basis, year over year, growth would have been 11.1%. Impressive. Also, they mentioned it here that average revenue per paying user. You see, the last time I told you that registered user is different from paying user, but now they're saying the average revenue per paying user was $133.73. That is one user paying $133.73 averagely. And compared to 2020, per user, average payment was $128.50. So there's an increase there. You can see here the revenue they generated is over $2 billion. That's what they generated in revenue. And compared to 2020, they were 1.913, about 2 billion as well. But they increased their revenue. And looking at cost of revenue, the cost of revenue in 2021 was 444.2 compared to 414.6. Now, gross profit for themselves in 2021 is 1713.7. So there's an increase if you compare it to 2020. Now, what's operating expenses, where they spend their money and everything? You have research and development. There was an increase there, so they spent more in research and development. Also, sales and marketing, they spent more, 427, and this is why they could afford to bring in more money. And general administrative, they reduced this as well. And there's one significant reduction they actually did, which is impairment related to real estate assets. So in 2020, they had about 398.2, and that has come down to just 31.3. Now this is a million, so there is a massive reduction here. And by the time you look at the total operating expenses and less that from the revenue, you find out that they have a net income of 335.8 at the end of the day. By the time you do all the deductions and everything, they became profitable in 2021, 335.8. Unlike 2020, they were at a loss. So they became profitable this year for the very first time. And looking at this financial statement, I think the profit is down to this part here that they did a whole lot of savings, impairment related to real estate assets. So technically what I can pick out from here and what they actually said, if you come down here, they were actually telling you that include impairment charges related to real estate asset as a result of our decision to shift to a virtual first work model. So just down to the COVID-19, people working from home, a whole lot of organizations went the hybrid way, and some people, they fast-tracked the way they could start working. So some organizations will be working permanently now online, while some will be doing the hybrid model. So I don't think this organization need so much property, so much lease, and they don't need to spend so much when it comes to property, lease, office space, and the whole lot. So that's a massive saving to them. Now, my question here is, would they have been profitable if they were still paying lease and everything, or is it just down to the savings? So that's one thing we should do. So I think the savings they've made there is one of the reasons why they've been profitable this year. Now, let's just go straight and look into the balance sheet, and let's look at their assets as against their liability, if there's any other thing we can actually pick out from there. So if we look at their balance sheet right now, you can see their assets as against their liability. Now this is their current asset, and the total asset they have is over $3 billion. Now this is an increase from 2020, where they had 2.387.2 billion. Now that has increased to over $3 billion. And let's look at their liabilities. If you look at the total liability, is 3.385.2. So the liability they have as an organization outweighs their assets. So they have more of liability compared to the asset. Now this could be in terms of borrowing, in terms of various things that they've actually done that is making their liability greater than their asset. Now all we just need to do is find out if they have enough money to keep them in business going forward. Now before I do this, I'll encourage you, if you're new to my channel, I'll encourage you to subscribe to my channel, hit that notification bell, and smash the like button. So this is one platform I also use to analyze stock. It's called Simply Wall Street. I'll leave a link for yourself down below. Click on that and start analyzing stock yourself using this. So with Simply Wall Street, they've talked about Dropbox, and from what they're actually saying, they say Dropbox is actually trading at 55.2% below our estimate of its fair value, and it became profitable this year, which I identified when we looked at the financials there. Now the risk analysis they're talking about here is that it has a negative shareholders equity and has a high level of debt, just like we said. However, we'll go down and we'll look at the financials down there. But before we do, let's look at Dropbox, if the valuation of the organization right now, the share price, if it's good for business. So now if we look at the share price versus the fair value, you'll find out that Dropbox actually closed at 23.18. And from the calculation they have here, they said the fair value for Dropbox is 51.70 as an organization. This means that Dropbox is an undervalued organization. But this does not mean that because it's undervalued, we should just go shopping and we should start buying Dropbox right now because it's undervalued and there's potential for it to actually grow. There's one thing we need to look at, and this is where we're going to. We'll now look at the financial statement as given by Simply Wall Street. So if we look at the financial health here, we can actually look at it that their asset short term is greater than their short term liability. However, their short term asset is lower than their long-term liability, and also their long-term asset is lower than their long-term liability, which gives a signal here. Now if you come further down, it tells you that DBS has a negative shareholders equity, which is a more serious situation than short-term asset not covering short-term liabilities. And if you look at the long term, they said it has a negative shareholders equity, which is a more serious situation than short-term asset not covering long-term liabilities. Now, if you look at their balance sheet here, it shows that they're in a massive debt of 1.4 billion. And they have 1.4 billion, but do they have money to run the business? Yes, they do. If you see, DBS debt is well covered by operating cash flow of 53.3%, and they have an interest coverage. DBS interest payment on its debt are well covered by EBIT, 59 times coverage. However, their debt level, which is with the negative shareholders' equity, is a more serious situation than a high debt level. And also reducing debt, DBS has a negative shareholders' equity, so we do not need to check if its debt has reduced over time. Now, this is one risk I want you to understand, that they have a risk here investing in this organization. And another risk I want to point out to yourself with this organization is that they play in an industry that is very, very competitive. There are so many people in this industry that do have the same thing they do. For example, like I said at the start here, I have Dropbox, but I'm not a paid user. However, I do have OneDrive as well. I have Google Drive. I have iCloud. Now, these are people that provide the same services, just like Dropbox. So the market they are in right now is very competitive. There's so many people in this market right now playing here. You have the likes of Google Drive. You have OneDrive for Business, Box, FileCloud. You have the likes of Amazon, iCloud, which is Apple. So those people bring competition to them, and these are like big boys in the industry that they do have their own devices as well. However, Dropbox is actually working effectively and looking for a way that they can stand strong in the industry. So they are looking at their competitive advantage, how they can win market share. And for this reason, they've actually invested so much in acquisitions. They've done a whole lot of acquisitions. They've done a whole lot of stuff going forward. In 2019, they acquired HelloSign, and in 2021, early 2021, they acquired DocSend. Now, not just stopping there. Even in 2021, although it was a very silent acquisition, they acquired Command E, and they're trying to bring everything together in one space whereby once you have Dropbox, you don't have to look at other software to do other stuff. Like you can sign documents using the platform and also send documents to other people using the same platform without you looking for a different app. So they're trying to set a space for themselves. They're trying to make themselves really competitive in the market space they're in. And with what they're doing, they'll have a whole lot of potentials going forward and a whole lot of things going forward for themselves. Am I going to invest in Dropbox? For the long term, I doubt it. I don't think I'll be a long-term holder of Dropbox if I have to invest in Dropbox. And the only reason is because I've invested in Microsoft. I'm invested in Apple already, and those people provide the same services that Dropbox is actually doing. So I see no reason why I should add Dropbox. And secondly, I do not want to increase the organizations in my portfolio right now. I want to leave my portfolio as small as possible and invest more in these organizations that I trust rather than add more organizations in my portfolio. That does not mean that I'm shutting Dropbox out completely. I have them on my watch list, and it could be an organization where I can go in for a short term quick trading, see there's potential for me to make money in a short term space, and I'll just make money 20%, 30%, and I'm okay with that. I could do that, but that does not mean that I'm invested there for a long term. So that's my position right now, and that's the way I actually see Dropbox going forward. So if you're new to my channel, I encourage you, please subscribe to the channel, hit the notification bell, and smash the like button.